Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We're all property people running our own businesses, and this podcast is just us chatting every week about the reality of anything and everything property. This week we are joined again by Simon Glastonbury, our expert mortgage broker, and we're just going to dive straight into the conversation. And I think we're going to start with a bit of a discussion on mortgage rates, what they are, where they're going, and yeah, over to you, Simon.
Well, welcome, guys. Good to be on again. Interest rates, certainly a poignant topic at the moment. Very, very busy from the mortgage side. Lots and lots of inquiries about what people are to do with rates. And that's across the board, from residential, single buy-to-lets, landlords, right through to portfolio HMO landlords. And because they're clearly going up, and with the potential rate rise again coming up, which is expected, what's going to happen? And I think everybody's sort of looking at cash flow a lot closer than they have been probably over the last 10 years, because the rates are jumping up. And within the last 6 months, quite a number of those rates or rates available and products available have nearly doubled already. And that's clearly a concern, along with the sort of energy crisis we have going at the moment. That's a concern to pretty much all of my clients. Everybody's ringing up and saying, look, can I get out of my current rate? Or when's my current rate expiring? What should I do? Landlords are then thinking, right, should I keep the properties? Do I remortgage? Is it available? Do I put rents up? I mean, you guys know exactly what that sort of situation is at the moment. And rates are at a point now where they are certainly being a concern to the majority of people who still have mortgages.
Have you found people actually changing their mind yet? As in, they've maybe put an offer in or something on a property, and they've come to you and talked about mortgages, and they've actually gone back and said, actually, I can't afford this?
It's a good question, actually. No, is a simple answer. Is that I've not had anything like that as yet. I think people are looking at it a little bit closer. I think the market availability of products at the moment, availability of property at the moment is still is the issue. So people, once they get it in their mind that either a landlord or someone looking for a residential property, once they have it in their mind that they want to find something, it's kind of set in stone. So although they're having an issue with finding that property, I think that's more the issue. I haven't actually had anybody personally pulled out thinking it's too expensive now, because they've got to do something. I suppose they've got to, if they're not living there, they're renting. And you're looking at potential rent rises as well coming up. I would expect that, certainly from what landlords are telling me.
And there's been no change in terms of the buy-to-let stress testing. So all banks are still implementing the stress test that had to be applied in terms of or has the rate changed? Because it was 5.5% at something like 145% or 155%.
Yeah, depending on if you are a basic rate taxpayer, high rate taxpayer, if you have, each lender has a slightly different stress test, but Stuart, you're absolutely right. It's around about those figures. Usually 5.5%, 5.5% works out 125 or 145. Now, that hasn't changed as yet. The question is, and I think certainly from a broker's point of view, will that change when rates are getting to that level, or go above that 5.5%? Because they're getting quite close to it now. We're not far away. If you're looking at an HMO purchase currently at 75%, you're getting up around. If you're a limited company, I mean, these are all sort of ifs and buts. But if you're a limited company HMO purchase, you're getting up around the 5% mark. So what happens? What are the lenders going to do when you go over? And this is clearly a directive from the regulator to say, look, this is what you need to do in the first place. So what happens when HMO rates go above 5.5 and there's 6? How is the stress test going to work there? Certainly on the broker forums, which are a joy at the moment, it's a burning question.
I think in a recent remortgage that I was going through, some of the paperwork, because they sort of try and scare you in some of it, and they had an illustration of what would happen if, and their example interest rate was something like 11 or 12%. Okay, that's really very scary. Hopefully it's not going to go quite that high. But yeah, I mean, it doesn't make sense if the stress rate is lower than the real rate. That's they're going to have to change something there.
Absolutely, it just doesn't make any sense. But they're all these quotations, and like you've seen, Simon, they're regulated to an extent, and they're trying to make it easier for the client. And quite often with any of these things, it just confuses people, thinking, because you're drawn to the higher figure, and you're thinking, what that? Of course, you're going to be put off. I mean, that would just be absolutely dreadful. You know, it's always possible. I don't think it will get anywhere near that, personally. But again, my view is, I think with the base rate rises potentially next week, it's realistic from if you're looking that it's going to go up another 0.5 realistically. So yes, you're then going to get, if the lenders follow suit, which as you guys have seen how quickly they're pulling rates and taking them off the market, we're going to have that drama, as he says again next week or the week after. They usually follow about a week or two after. They're not that quick, surprisingly enough. Lenders don't automatically immediately pull rates. They usually there is a sort of a run-in period, and it's usually about a week or two. So everybody does have a little bit of time.
A week or two sounds pretty quick to me, but I think it's because the lenders obviously arrange their borrowing sort of in advance of when they lend it out. So I guess the lag makes sense.
Correct.
How are you seeing other characteristics of what's available? As in, are you seeing mortgage lenders being more restrictive in things like loan to values or salary multiples and things like that? Sort of other characteristics of mortgages, are they changing? And
no, not really. Not of late. I think that goes back to when we talked some time ago regarding service. We've noticed that's the biggest issue within the industry, bar none, I think, at the moment. Sorry, apart from obviously interest rate rises, but that's a cost thing rather than if you've made the decision or not. The service with lenders at the moment, what they tend to do is they've increased rates. It's so clear, they won't admit that clearly, but it's so clear that to reduce the number of applications coming through the door, they don't want to go on what we call our sourcing systems. We have software here that the lenders update all the time, so we know literally minute by minute what the latest rates are with all lenders across the board. And you can see the usual suspect. If anybody's been particularly bad with service, and it's quite a few of them, and some are still in trouble, you can still go to one of the main high street lenders and wait 20, 21 working days before your application is initially looked at. So what you'll then find is they'll go down the sourcing system with rates, so they're not so attractive. So equally, we've not seen anything exciting within income multiples, or as Stuart was saying, stress testing. There's nothing really come on the market to say, come use us. Although a fairly funny story, Stuart and I have had some interesting issues recently with a particular lender, and they've been sending me emails promoting their products, which I find quite laughable, when they can't provide service to existing clients because it takes months, but they're marketing, their new fixed rate over 5 years and come and use us because we're excellent. That's quite laughable, really. Although I laugh nervously.
You laugh nervously in my vicinity, is that right?
Yeah, unfortunately so, yeah.
Well, yeah, I mean, obviously, we shan't speak ill of them at the moment, but yeah, just a further advance, taken best part of 5 and a bit months to get that done, which in anyone's money is a pretty long time. particularly when you're looking for that sort of funding and when it's all been approved. And I think that was the biggest challenge for us. It was all been approved. But one thing that stood out to me, and obviously staying professional without dropping into a whinge fest about that, but one thing that was interesting is that you did talk to me, although I was quite envious at the time, but about another bank that does everything, online. They've got their sort of digital infrastructure. I think it's TMW you mentioned, where actually that's all done online. The decisions are made online. So it's probably worth calling that out as well as calling out the negative aspects as well, isn't it?
Absolutely. No, good point. And we did touch on this briefly, didn't we? A number of lenders, and we do spend as brokers, we do spend our life, hitting these lenders over the head, particularly when it comes to service, because we're in between the two. You guys want to know exactly what's going on. You clearly want it done as quickly as possible. The lenders, we just go into a black hole and then sit on the phone for hours at a time. But some are very good. TMW, for example, you mentioned, Birmingham Midshire is also very good. So most of the high street banks, when it comes to rate switches, will have an automated system. Some are better than others. Some are immediate. TMW, for example, you literally, as long as you're within I believe it's 3 months within the rate expiring, for an example, you go on, it automatically gives you a list of products you want. You tick yes, you agree it with the client, and it's done. I mean, if they can do it, why does it take others? And they're usually the smaller, more specialist lenders, but they all have online broker systems, which they clearly need to invest in, because it's some of it is that some of the service, as Stuart was saying, is absolutely appalling. And why would it take someone 5 months to do something another lender would literally do in 10 minutes? It makes no sense.
The worry for me just on that is just, and again, we're not going to make this into a podcast just to moan about certain banks, because we could do that for hours. But I think the thing that concerns me is that lending is your primary function. If you're a mortgage lender, that's your modus operandi, isn't it? Your business doesn't function unless you've lent money. Yes, you've got to underwrite it. You've got to make sure you're lending to, and given all the things that have happened since 2008, you've got to make sure it's sustainable lending. I get that. But when you're, in this case, it was we were talking about further advance that wasn't more than 50,000. It was less than 50,000. So in the grand scheme for a bank, not a lot of money, relatively speaking. And my frustration is that my company has several mortgages with this same bank. So you have to jump through the same hoops, and then it takes them the number of months to actually provide you those funds. And I worry about the longevity of a bank like that. If they can't get the first part of their job right, which is actually getting the money into the hands of the people they need to, because otherwise they're not making money as a business. So how can that continue?
I agree. And also we spoke again, and it as a client, as a broker, as a business, you're put off by that lender, and that's why I said it was quite laughable when they're then sending marketing emails to promote themselves and say, come to us, bring your client, bring your portfolio landlords to us. No, quite simply, I'm not going to do that, because you're simply appalling. And that's the thing, and you're quite right. How do they expect to survive? The problem is they will, because brokers have a very short-term memory, and we will go back onto as I said before, our software systems, and say, oh, right, that bank is back up at the top. They have a really good rate. You know what? It's difficult. And you speak to the client, and I would probably say, I'm guessing here, but 9 times out of 10, if you say to a client, you guys are there, you've been in this situation, right? I can go to this bank. It has X rate. They are the cheapest. They're the best. Best service, but they have the best available rate. But let me tell you, the service is appalling. Or we go, it's slightly higher, and we can go to another bank where the service is pretty good. Now, most of the time, people will go for the lower rate. So you're already drawn back to that bank when you don't want to use them. So it's quite difficult, and I think they just rely on that.
Moths to a flame, aren't we? Moths to a flame.
Absolutely. It's shocking. Don't get me started on that.
Okay, we'll change the topic. Going back slightly, you mentioned TMW being good in their processes, and I've actually been through that process very recently. So I've had a long-term tracker mortgage on one of my earliest properties, and it's been sitting very nicely on that tracker for many years, over 10, and I've been really enjoying those lovely low rates for the recent years there. But I saw rates going up and I thought, right, it's time to jump to a fixed rate. And I've jumped to a fixed rate at the point of jumping, at least, where the fixed rate was a reasonable bit higher than my current tracker, even sort of looking ahead, probably for, at the time, 1 or 2 Bank of England base rate increases. And just to finish the bit about the service, the process was so simple. I mean, I don't know, maybe my broker in the background was having to work overtime to get it done. I don't know. But from my point of view, it was extremely simple. My broker already has most of my details. And they sent me an illustration, as you said. I said, yes, that's fine. And I don't know, a week, maybe 2 weeks later, they said, great, that's all done. And that was it. It's so simple. But the point I actually wanted to get to was, how do you feel about tracker rates versus fixed rates, both sort of now in the current environment of rates increasing, but also if we try and average them out over a 25-year term of a mortgage? Do you think staying fixed and jumping from fixed is likely to work out best, or could the tracker mortgage actually, in the long run, be a better bet?
$1 million question. And I think what you will find, you could probably talk to 10, 20 different brokers and have a different answer from everybody, because it's an opinion rather than anything else. I mean, certainly what I'm doing is now, for the first time, starting to make people aware, look, this is what's available on tracker rate. This is available on the fixed rate. The lenders are not very aggressive on their trackers at all. So you can read into that what you will. I would certainly say, from a personal point of view, and then we're talking to clients and clients looking for recommendations, I still believe that fixed rates, depending on where you're going, between whether it's a residential or you're looking at the top end of rates, which is generally a limited company, multi-unit or HMO, is a sort of the top end of rates. You're looking somewhere between 4 and 5%. Now, for a 5-year fixed rate. Now, what do we know about rates going forward? Well, they're still going up. You know, that's where I think if you ask 100 people in the street, they'll be expecting your rates to go up somewhat for the rest of this year. Where are they going to go to? Is anyone's guess. I think the feeling is somewhere between 3 and 4%. Does a tracker then become attractive when you're looking at 4 and 5% fixed rates over 5 years? It's a very difficult one. I would still steer towards a 5-year fixed rate, because I think historically that is still a very, very good fixed rate over that period. And I think with the uncertainty in the marketplace, we're still uncertain about the property market. What's going to happen with property? Is that going to become quite active again? What's going to happen with the potential recession we're going into, with inflation? Certainly from a landlord's point of view, like you guys, cash flow, budgeting, working out exactly what you want. I think there's too much of a risk to going into a tracker. But also, again, somewhere, if you can get a tracker rate which you can switch with no penalties over to a fixed rate, if you can get out there, depending again if it's buy to let, residential, there's a lot of anomalies here, but if you can, that might be an idea. If you quite like the idea of a tracker, but I would certainly, if it's me and it's my money, if I'm looking at it and that's how I like to advise, I'd still think rates are historically low.
Yeah, I mean, the two factors that led me to moving mine were rates increasing, and if I did it early enough, which hopefully I did, then I will end up having 5 years of lower, but also the hassle factor and the certainty, safety, if you like, factor of knowing what those payments are going to be, rather than sitting on the edge of my seat for every Bank of England base rate announcement. Just as a sort of quick idea, the tracker that I gave up was a 1.25% above base. What sort of above base trackers are sort of on the market at the moment?
Oh, there you put me on the spot, Simon. Let's look at a standard buy-to-let. Here we go. We have one here. Quite attractive, actually. Standard buy-to-let with a customer up to 10 buy-to-lets, 2-year tracker at 2.39. That's Bank of England's base plus 0.64. So pretty attractive.
You said that's a 2-year tracker. So what does that revert to after the 2 years?
It will then go to their standard variable, whatever that may be at the time. They have this is actually with TMW at the moment. I'm just looking on there, which gives a they're pretty much market leading in a lot of standard buy-to-let products. So that's quite good. Comes with a £2,000 fee, thereabouts. That's up to 65%, 75%. Bank of England base plus 0.74. That's it. That's for purchases and remortgages. So yes, still, that's quite a bit lower than their 2-year rate, which is 3.89. But that's going to go up by next week by 0.5 as a minimum, I would say. From talking to expert people who know a lot more about it than I do. But again, Simon, it's exactly like you say. Do you want to wait for each Bank of England announcement to sit there with your... It's probably okay if you have one. And you think, well, that's okay. I've got some leeway there. The rents, I reviewed the rent last year. It's gone up. I'm making X amount of pounds on it. If, like you guys or others who have a portfolio, you have half a dozen products on tracker, naturally you're going to be nervous. I think that's then the issue. Yes, that in that particular instance, nice rate, but it's going up. So and it doesn't take long before it's up and above the fixed rate.
Yeah. At this juncture, I should also just shout out to Alfie Chats, who sent us a tweet about this a little while ago. So Alfie, I'm hoping this conversation helps you. Let us know via Twitter. That seems to be your preferred method of communication. But this is a conversation that does come up fairly often. In fact, a friend of mine contacted me very recently and said, look, I've been offered a tracker or a fixed. And he said, my tracker was 0.5% higher. And he just said, what should I do? And it's one of these questions that people ask you, and I'm sure you get it asked all the time, Simon. Of course, we're asking it of you now. But I kind of said to him, well, look, ultimately, it's going to be your call. I said, if you're going to pay, I think it was 0.5% more on the fixed as it stood, on that day. I said, so you need to just work out that maths to see if you're happy with that. But of course, factor into the fact that bank rates could happen at any time and seem to be are obviously happening more frequently. I said, but my perspective has always been a bit like, we've been talking about, was a bit of set and forget, and particularly when you're in the rental market, you do want to just fix these things and plan. And so typically, my terms have always been shorter just because of the works that we do to the property, and that has cost us quite literally. It's put a lot of cost into the business. Whereas now I'm thinking a bit more long term, and we are going to set and forget. But I think in around what we're talking about today is that really the individual has to have a look at the numbers and work it out, because it is quite simple. Obviously, that with a variable stroke tracker, you're at the whims. And yes, of course, the base rate could go down, but I don't think any of us are thinking that's going to happen anytime soon, given the fact that we've had low interest rates for such a long time. Yeah, and that's where fixed does make more sense. But then people look at it and say, well, I'm paying more for that security. And that's kind of the equation that everyone has to work out for themselves with an accountant and or broker.
Yeah, absolutely. Everybody's different. That's the thing. It's not a sort of one rate. It fits for everybody, and I see that on a daily basis with different clients who are in different situations, and we all have that. We all have a different risk view on where we want to go. So some people will certainly say there is absolutely no way they're going to go on to anything other than a fixed rate. And then we have someone else, again, whether it's a portfolio landlord or just someone who has the odd buy-to-let here and there, and say, oh no, well, give me some options. Let me see. Let me take a view. What's your through? And I think anybody, and talking to anybody out there in podcast land, is certainly speak it through with your broker. Your broker will, if you have a good relationship with them, will be having this conversation every day with people, and will have a feel for what the lenders are doing, what other clients are doing, other people in your situation, and give you an overall view. Now, whether they recommend a fixed rate, whether it's 2, 3, 5, 7, 10 years, whatever it may be, or a tracker, the decision is yours at the end of the day. They can only guide you and make a recommendation, but take as much information as possible. That would be certainly my recommendation for the day. Is get as much information as you can. Look at trackers. I mean, there are not as many trackers out there if you are the professional landlord. You're looking at limited company buy-to-lets and HMOs. They're not those sort of products are not out there as certainly as much. And again, read into that what you will. Why are lenders not providing those sort of those tracker products to that market? Are they not being taken up by clients, or are the lenders nervous about offering them to professional landlords? Who we don't actually know, but certainly take advice, talk it through before just immediately making that decision to say, right, it's got to be a fixed.
Yeah, there's a big wide mortgage market out there to investigate before making any kind of decision. I think it'd be good to finish up with a sort of traditional, having done it once, quick fire round on some example mortgage rates. But just before we do, is there anything else sort of happening in the mortgage market at the moment that you would like to mention?
There isn't anything exciting going on. If the mortgage market can ever be exciting, that's a question itself. Product-wise, I think lenders are definitely nervous. Lenders are nervous about interest rate rises to ensure that people are not overstretching themselves. Clearly, they've been maxing out on borrowing over the last 10, 12 years at extremely low interest rates. So they're very aware that over the coming 6 months, year, 2 years, people are going to be jumping off, whether it be buy-to-lets or residential properties, are jumping off very low rates, and all of a sudden their mortgage is going to be doubled in many occasions. So I don't think they're going to be coming out with anything attractive in the foreseeable. We hope they are. But at the moment, it's a case of let's wait and see. Let's see what's happening with rates, Bank of England base rates certainly, and then go from there. And I think all of them are kind of holding back. Although I'm still seeing lots of people buying. So, how long may that continue?
Okay, so quick fire. So this is obviously today. This is a few days before it will go out to the public. And that in turn is a day or two before the next expected Bank of England announcement. So we're only talking about right now, and this is only very vague guide. Don't rely on these numbers. Talk to your broker. All that said, what sort of rates are you seeing for residential homeowner mortgages? What's a good rate there?
Residential, you're looking at, again, if you're looking at a sort of five-year fixed rate at the moment, if you're a residential owner wanting to remortgage, you're looking at about 375 with your standard fees-free remortgage. You can now get residential purchases at 95%. They're becoming more popular, actually. Just over the 4% mark, 4.14. I feel is the best rate on the market at the moment. Got to say, in this current market, that's still attractive. I think that's still very, very good. So the difference between that, I think that's quite unusual. The difference in loan to values there, I'm talking about a 75% remortgage at 375 and a 95% purchase at 414. Not a lot of difference, really.
No, for that significant extra risk that the lender's taking on and the value of the property. Yeah, there's not much difference in the rate.
No, very, very, very unusual.
Okay, so moving on to our starter investor looking at single let, buy-to-let property in their own name without an existing portfolio. What sort of rate are they looking at?
Surprisingly enough, I've had a look at this. Very similar to the residential. 374 at 75%. So again, that's very unusual. But I think because of a lot of the big lenders have changed. As I was talking about our sourcing system, and with very bad service at the moment, they've upped their rates on the residential side mainly, so they're not getting the business in. And I think that's the feeling across the marketplace. They're playing that game, and therefore the buy-to-let lenders are coming in, and certainly the ones we were talking about who have excellent broker portals, who there's a lot of automation there. Yeah, 374. I still think that's a very good rate. Again, 5-year fixed rate, and these are changing all the time, as you guys know. They're being pulled all the time and change, but that's kind of where they are at the moment. Limited company is a little bit different. If you want to buy in a limited company, it's 475, so you're going up about 1%, which is pretty much the norm. That's probably around sort of where we'd expect it to be. And again, from day to day, the thing is check with your broker, because rates they're moving like we haven't seen them for 10 or 12 years. So just because it's available today doesn't mean it's going to be available in a couple of days' time. That just doesn't. Those days are gone for the time being.
Okay, and final one, HMO borrowing in a limited company, is that any higher than buy-to-let borrowing in a limited company?
You'll generally see it slightly. So if you're looking at an HMO property, multi-unit block, you're looking at around something just under the 5% mark. That's kind of where you should be, where you should be looking at. And obviously the stress testing on HMOs, multi-units, is not really too much of a concern, because normally the rentals are so much better. But yeah, somewhere up around the 5% mark is where, so you can see, whereas previously we were seeing HMO limited company borrowing an awful lot higher than residential, they've become very, very close over the last 3-4 months.
I remember that particularly on the 85% loan to value HMO product, it used to be, because I had so many of them, 5.29, and that's come down quite a bit now. So that's one bit of positive. Based, like as you've just said, they're now just marginally under 5%. So that's been a small plus when they actually get to being able to give me the mortgage. That is obviously.
Yes, he says nervously, but yeah, absolutely. But I would expect that to. It's interesting again, we could go off on that tangent. Why are the lenders offering 85% rates at so low? It does seem quite strange, but obviously, as you said before, Simon, about the lenders are buying in that money. They're factoring that in over the next 5 years, so they're able to do it. They know something that we certainly don't. But if you can get that up there, if you can get up to 85% on an HMO at around 5%, I still feel, certainly from a broker's point of view, still think that's good money. Really, really good money, and that's a really, really good investment. The residential side, no, not so much. That's becoming a bit uncomfortable for a lot of people. But certainly from a portfolio landlord's point of view, 5% on an HMO, I think that's good.
Yeah, and there's not that much difference really between the buy-to-let and the HMO, and yet HMO revenues, energy prices permitting, are potentially much, much higher.
Don't get me started on that.
Okay, we're finishing up now. So we will make sure contact details are in the show notes, but how can people reach you, Simon?
Come and visit our website, jsiassociates.com. Any inquiries, you just want to talk things over, or mortgages, always here to help anybody and to give advice.
Fantastic. And thank you very, very much for sharing so much of your knowledge with us today. And for everyone listening, please do leave us a rating and review, or just a rating if you so wish. We really do appreciate them in whatever podcast listening service you're using. You can find show notes and details of all previous shows at thebusinessofproperty.com. And we will talk to you again next week.